All right. So thanks again for everybody that's logged in. Today we're going to talk about identifying and finding cash flow investments in today's volatile market. Obviously, all of us are reading the news. There's a lot of information being thrown at us. We're dealing with inflation. We're dealing with banks. Three prominent banks have recently failed. And we're just coming out of an economy that has been closed down as a result of COVID. So all of kind of like a super trifecta going on right now, and want to take an opportunity to talk about where that opportunity is. So before I get started, I want to just say that that this presentation is for informational purposes only. I'm not here to pitch you on any deals or any investment. It's up to you to decide if this is the right investment for you. Today over the webinar, we're going to talk about a couple of things. Number one, I'm going to give you an overview of who I am and TaliMar Financial, my company. We're also going to discuss the problem of investing in real estate today. We're going to talk about, why there's a lack of opportunity out there. We thought that the market was going to slow down, but it obviously is not. Not a lot of properties listed on the market. And so where is that opportunity? We're going to go into then talking about my strategy of investing, something that I have used over the last 15 years that in today's market works very well. We're going to talk about best practices using my strategy. So what is it that you can implement that not only will reduce your risk, but increase the returns that you can earn? I'll talk about how you can get started. It's a very easy strategy that I use. It's very easy to get started, or if you already started, to increase your business. So we'll talk about how you can do that. And at the end, we'll leave it to Q&A. So ask any questions and answers. As I said before, feel free to ask any questions throughout the webinar. So a little about me. I actually started in real estate finance back in 2001. Prior to that, I was in the tech industry, but really was fascinated about real estate, and specific about it was real estate finance. I worked for a private equity fund for a couple of years, almost 5 years, and then had an opportunity to work for the FDIC for 2 years. During my stay at the FDIC, me and my team were the ones that would go out around the 10 and 11 timeframe, and we'd go in and shut banks down, banks that were failing. We'd go in on a Friday evening and then underwrite their loan portfolio, and then make sure they reopened under an assuming bank on that following Monday. It was a great opportunity. Worked with some very, very smart people, but moved on from there. And that's when I established TaliMar Financial. I was investing on my own behalf prior to that using this strategy, but I actually went and created a company around it right around that 2011, 2012 timeframe. I have funded over $375 million in short-term real estate bridge loans. I'll go in and explain to you what that is. And I've returned over $23 million over the last 10 years to my investors with no investor losses over that period of time. I am a California mortgage broker licensed, or I'm licensed California mortgage broker, and I am a certified fund manager. So I'm certified in running a mortgage fund. Currently live in San Diego. Got a beautiful wife and 3 kids. I've got the kids. My wife is in Europe on a business trip, so I've got them, and hopefully we're going to be okay. When I'm not in the office, I play competitive tennis. If you want to find me and I'm not in the office, I'm going to be on the tennis court. I love playing tennis. A little about my company. It is a real estate finance company. So we fund short-term bridge loans. That could be bridge loans, fix and flip loans, but loans primarily to real estate investors throughout the state of California. We do run a mortgage fund. That mortgage fund is the capital we use to fund these short-term loans. That mortgage fund is comprised of high net worth investors that want to invest using my strategy. We've raised over $41 million over the last 2 years on behalf of high net worth and family offices that invest in our mortgage fund. And we service a loan portfolio of a little over 55 million. So we've got, I think we're up to 90 loans in our loan portfolio, totaling over 55 million. And that returns over $260,000 per month to me and my investor base. We have 7 employees, primarily here in San Diego, but we have employees all over the world. It is a nonstop industry, so we're excited to have them all over the world. So let's go ahead and get started here. I want to identify the problem right off the bat. So many of you know that I invest primarily in real estate. And one of the biggest problems investing in real estate today is finding opportunities that offer consistent monthly cash flow. They offer security and low volatility. So I say security and low volatility because you can compare my strategy of investing versus maybe investing in the stock market, where you're just dealing with consistent volatility, geopolitical issues that are going to move the value of your investments up and down. My focus is to ensure that we have low volatility. We want to keep a straight, easy, consistent investment that offers consistent monthly cash flow. And I'm going to use that term a lot over this webinar, using the term consistent monthly cash flow. So every month you earn income, keep low volatility, and feel that your investment is secure. Also, you want to be in investments that are liquid. Things are changing all of the time. So how quickly can I get out of my position? How quickly can I get out of my investment? And then opportunity. Look, there's places where you can make a lot of money in almost any sector of the economy, but is there an opportunity at this point to invest? And I'll say that right now, using my strategy, there is a huge opportunity and it gets bigger every day. The reason it gets bigger is, number one, banks are pulling back on the lending. They're trying to create liquidity on their balance sheet. And so there is the banks that have traditionally served the market that we lend to are not lending right now, leaving a huge void for private lenders to come in and fill that void. And this is where I'll go in and talk about my strategy. And then the tax benefits. So using my strategies, there's some significant tax benefits as a result of the 2017 Tax and Jobs Act. And I'll get a little into what those tax benefits are. So we've identified the problem. We're looking for investments that offer consistent monthly cash flow, the security and low volatility of the market. So what are the hurdles that we're dealing with right now? And what are the hurdles that are creating this opportunity? So first off, we're talking about that pandemic, COVID. It shut the economy down for literally 2 years. And then during that period of time, the government pumped in a significant amount of cash into the economy to keep it moving. As a result, we're dealing with what is today inflation, a significant amount of inflation. And to deal and combat with inflation, the government has been raising, or the Fed has been raising interest rates. So we went from a near zero rate environment to a much higher rate environment. They did that to slow the economy down, to get liquidity out of the market, make it more expensive for people to borrow. And as a result, assets that people borrow against become more expensive. That should bring the value of those assets down, should bring the value of assets of real estate down, should bring the value of stocks and other investments that you can buy on margin down. And really, that's kind of what we've seen. Real estate, not so much. You've probably seen the numbers have just come out over the last couple of weeks, where you really see certain sectors of the real estate economy really strengthen, especially here in San Diego, where values have now come rocketing right back. The other issue that has occurred as a result of increased inflation and now increased interest rate is failed banks. Many of these banks made bad bets investing in long-term debt on their portfolio. That created a liquidity crunch for them. And I won't go into detail about why that occurred, but it did occur. And so you have a lot of banks now trying to add liquidity to their balance sheet so they don't become the next Silicon Valley Bank. As a result, they're not lending. And the loans that they do have that are maturing, they're requiring the borrower to pay that loan off, and so that they can get liquidity back on their balance sheet. All of this has created a triple trifecta and opened up a huge opportunity for the private lending industry. So what is the biggest problem today? It is liquidity. The value of your cash, the value of your deposits, of the money you have made over your entire career that is deposited somewhere or invested somewhere, the value has gone up. Someone will pay you more today for you to borrow that money than they did just a year ago, and a significant amount more to borrow today. Okay, that's the opportunity. That is the issue. Borrowers in the real estate industry have a problem today because of liquidity. It is more expensive today to borrow than just a year ago, and significantly more. So I want to show this to you because it isn't me just telling you that there is an issue, a void left by banks. Bloomberg had a great article a week or two ago talking about, and they used the term shadow lenders, and I hate to use the term shadow lenders. It's really the private lending industry is the term they should use, but shadow lenders to bridge real estate void left by banks. So they're highlighting the issue that is today, which is banks are not lending. Real estate investors and big groups are relying on the private lending industry to provide the capital that they need to continue to operate, to continue to invest. Okay, so before I say, look, this is cataclysmic, this is terrible, everything is bad. Look, it isn't bad right now. I can promise you. If you look back at history, we've been worse off. You know, we had the 1918 flu pandemic, over 675,000 people died. We had the Great Depression, where unemployment reached near 25% of the population. GDP declined by over almost 27%. Okay, we had World War I, World War II. We lost over 500,000 people and troops in both wars. We had the oil embargo, where inflation was out of control. If you think it's out of control today, it was out of control back in the late 70s and early 80s. We had the terrorist attacks, okay? And obviously we had 2008 Great Recession, where unemployment reached 10%. So today, right now, the volatility in the market, yes, looks bad, but we have been in worse situations and we have come out stronger. And I fully anticipate we're gonna come out stronger from what we see today. I am very bullish on the US economy. I'm very bullish on the US worker. Back in 2008, there was a great interview with Warren Buffett, and he said that. He said, there's no other place that I would put my money except for the US economy, and he's right. So here's something that you can't do. You can't just hide. You can't go get in a box and decide not to do anything. You've got to take action, okay? But where is that action going to be taken? Where are you going to invest today to earn a good, consistent monthly income, reduce your volatility, reduce the risk that you have on the money that you have made over your career? And this is it. It's become the bank. So I've identified the problem. The problem is the banks need liquidity. They need to put liquidity onto their balance sheet. They are not lending. So they've left a huge void open for private lenders like me to step in and lend the money to what would have been their clientele. Okay, this is nothing new. Okay, this has been, what I'm doing has been done since the beginning of time, or human beings, I guess. And that is lending money to individuals using real estate as collateral. You are becoming the bank. You are doing the exact same thing that a bank does. You're lending money, you're securing your loan with a mortgage or trust deed, whatever state you're in, and that borrower is making monthly payments to you. The only difference that's occurred over the last decade is that you're actually getting paid pretty good returns to be lending your money out. And the best part of it is, it's simple, it's easy. And I'm going to go through the step-by-step process that you can do to do this. And I'm going to give you the tips that I have, or the metrics that I use to lend the money out. All right. So I also want to highlight the idea that, look, I'm not the only person that does this. In fact, some of the biggest investment banks have their own private lending arms. We got Blackstone, KKR, Carlyle Group, Vista Equity Partners. Nomura has one of the biggest or it's one of the biggest sources of capital for this industry, TPG being another one. These are all huge private equity funds that are investing in this market. And they're doing it because they can get consistent monthly cash flow. There's huge opportunity. There's a ton of opportunity to get money out the door to lend into this industry. And so you're not the only individuals or investors that would be interested in this industry. It's big, big business. All right, so let's go ahead and get started. What is it that I do? So as I mentioned earlier, I lend money to real estate investors with short-term loans. So these are individuals that either buying single-family, multifamily property to renovate them and sell them, renovate them, lend them out and refinance them. But these are typically borrowers that don't have access to conventional financing. Especially today, as we talked about, banks aren't lending at the rate that they used to. So they need to come to the private lending industry like TaliMar Financial to get the financing they need to purchase a property. We've all watched Flip That House. We've all watched those flipping shows. Those investors, those banks are not lending on those projects. Those borrowers, those people that you see on TV are borrowing money from companies like mine, private lenders, to purchase those properties and renovate those properties. Banks are not interested in financing those projects. They're short-term. Banks see it as higher risk investment. Many of these borrowers need to close very quickly, and a lot of them don't show the cash or credit that they need typically to get bank financing. So you, as an investor, are stepping in the shoes of a bank. And you are becoming the bank, and you're lending money to a real estate investor using real estate as collateral. I'm going to say that because you're not just lending money. Your money is secured on a piece of real estate that investor owns. So if that borrower cannot perform on the loan, they can't make those monthly payments, they can't pay the money back once the loan matures, you can always go and sell that real estate and get your investment back. Now, you've got to do it right. You've got to use a strategy that I have to ensure that you're doing it successfully. But that is what you're doing. And what's great about this investment is, number one, you get monthly cash flow. Like I said, I'm going to highlight this term monthly cash flow. I hope you are dreaming the term monthly cash flow at the end of this webinar, but you're earning consistent monthly cash flow. Number two, you've got that security of real estate. Your loan is secured against a real estate asset. That could be a single family house the borrower owns, a multifamily property, maybe a commercial property, whatever it is, you are secured on that real estate. And the best part of this, what I think is best, you don't have to own the real estate. You don't have to go out and buy the real estate. You have to find the real estate. You don't have to get the financing for the real estate. You don't have to manage the tenants in the real estate. You don't have to do any of that. You're simply lending your money out and earning consistent monthly cash flow. The same advantages that you would get of owning real estate, but you don't have to actually operate it. You don't have to manage it. And for many investors who want to invest in real estate, get nervous or scared or don't want to get involved because they have to own real estate. You don't. You can earn the same consistent monthly income that you would earn in real estate by owning real estate by simply being the lender. And the best of all, I already said the best of all, but this is even better than the best of all, is that there's more opportunity than you will ever be able to fund. Right? I have more loan requests that come in through my door than I have capital available to lend on them. So I can select the very best loans in the market that I focus on. So those are the reasons why I'm involved, why the opportunity exists. So let's go ahead and talk about how to get started and kind of the tips on what to do. So why trusted investing? I talked about this on the last slide. So if you were to look at investors that work with me, okay, the prototypical investor wants to be involved in real estate somehow. They don't want to own real estate. Okay, many of them are nearing retirement or in retirement. So they're looking for consistent monthly cash flow. They don't want to dealing with tenants. They want to go enjoy the lifestyle that they have earned for working over a period of time. Maybe they've worked for 30 plus years. Maybe they ran their own business, something that they want to enjoy their retirement. And so they invest in trust deeds or using this strategy to earn that consistent monthly income. But they like that security of real estate. They like the idea of, hey, my investment is secured on a real estate here in San Diego. And worst case scenario, if the borrower stops making payments, what do? I own a piece of real estate in San Diego. Could be worse, right? So they like the consistent monthly income, the ability to invest locally. So I'm here in San Diego and I specialize in implementing my strategy of lending here in the San Diego market. And that's because I know the market. I can go drive and see the properties that I'm lending against. I personally know most of the borrowers that I'm lending to, and the loans that are being, the loan requests that are here in San Diego, the first person they're going to think to go to is my company. Okay. So we really don't lend outside of California. I know California markets, I stick to them. There's a huge growing opportunity. As I had mentioned, if you talked to me maybe 2-3 years ago, there was a lot more capital in the marketplace. I'm competing against banks. I'm competing with other investment firms. That has completely changed. I'm no longer competing with banks. In fact, I get loans that many banks would fund all day long. And it's a head scratcher of why this borrower needs to come to the private lending industry to get a loan. And every time they say, look, I typically use XYZ bank, but they're not lending right now, or the terms that they're offering just don't work for me. So I have to go to the private lending space. So that opportunity is there. And the returns, where I was earning maybe 7.5%, 8% on my money a year or two ago, I'm now earning 10 to 12% on my money. So those returns have grown substantially in less than 12 months. And if I'm earning 10.5%, 11% on my money, secured in first position on a loan here in San Diego, I'm going to take that bet all day long. I don't deal with the volatility of like in the stock market. I get that fixed income and I get that security of real estate. And best of all, it's easy. Okay. It doesn't take a rocket science. In fact, you really can lend based on your gut. Like, hey, does this make sense? Does this loan make sense? Do I feel comfortable with the real estate? Do I feel comfortable with the borrower? Do I feel comfortable with the entire request? It's easy. So I'll get into how to do this. Okay. So why does the market exist? Lack of liquidity, need to close quickly. So why would a borrower come to a private lender like TaliMar Financial, come to Brock to borrow funds? Again, we talked about this, the lack of liquidity, okay? The need to close quickly. In today's market, especially in San Diego, we're funding loans in 5 to 10 business days. That's because that's how quick investors need to jump on opportunities. That's how strong the market is here in San Diego. They have to close quickly to obtain, to win that deal, okay? And the banks can't move quick enough to fund a loan. So they need to come to the private lending industry. Third, many banks don't offer the loan types that we offer. So one of the big loan types that we offer, that we talked about, is that fix and flip loan, where the borrower is going to buy the property, renovate it, and then sell it for a profit. Banks aren't going to be involved in that transaction. They got to close too quick. Typically, there's a construction holdback, so the funds are held back for the borrower to draw upon over the course of the project. And the loan is only outstanding for 6 to 9 months. Banks don't want those kinds of loans. They want to have long-term loans on their portfolio. Fourth, unable to demonstrate credit or cash flow. Now, what I don't want people to think is when you're investing in the private real estate debt market is to be lending money to people with bad credit. That is not what we do. Okay. In fact, I have a base of 675 credit score or higher. I want to work with premier borrowers who have good cash flow and great credit. The thing with banks, on the other hand, though, is they're going to dig very deep into a borrower's credit history or cash flow history or whatnot. We've all gotten mortgages, right? We know how difficult it is to get a mortgage these days. They're looking down checking statements and asking why certain transactions are occurring. If a borrower needs to close in 5 or 10 business days, they don't have time to be responding to those kinds of questions. In fact, many investors out there own numerous amount of properties. Okay, they may be for tax reasons, taking depreciation, which may have a negative impact on what is perceived as their cash flow. banks have to underwrite to all of that. In the private lending industry, you don't necessarily need to underwrite to all of that. Another problem we see a lot of is issue with the property or ownership of the property. So maybe the property isn't in a good condition. Maybe the borrower needs to add some value to the property. We're okay with that. Banks are not. Ownership. A lot of cases, borrowed loans will come in where you have 2 or 3 different owners of a commercial real estate and one wants out. Well, banks want to understand why. They want to go back through the cash flow. They want to understand the financials of the remaining borrowers. We're not as concerned about that. We're looking at what is our equity or what is the borrower's equity in that property. And then refinance an existing loan. These become the most popular private money loans right now. Banks, as I mentioned, are not extending loans that are maturing. These are with borrowers that have great credit, great payment history. I mean, they've never missed a payment for 3 years, but because they got a 5-year loan with a bank, that maturity is coming up and the bank isn't willing to refinance the loan because they need that liquidity. So they need to go to the private debt market to get short-term financing to refinance their existing loan with that bank. And so they're coming to the private debt market, like coming to TaliMar to get those loans. So let me highlight some of these successes. I wanted to show you kind of the successes that we've had recently. On the left was that property that we financed about a little over a year ago. Borrower went in, rehabbed it, sold it within about a 9-month period. And we earned the interest rate on our loan was 8.75%. That was an annualized return. We earned it over a 9-month period. Very good success. Okay, that borrower is going to come back to us for more financing on more projects that they're going to be purchasing. On the right, same deal. This was, I think we funded this about a month and a half ago. We're earning 10% on our money on this purchase. So these are examples of the opportunities that are out there, the type of collateral that you can secure your loans against. In fact, I think these are the last, I think this shows probably in the last 6 months, some of the loans that we've done. Single family home, loan size was 625. We're earning 10.5% at 65% loan to value. What is that? What does loan to value mean? It's a very simple calculation. Imagine if you had a house and it was worth $100 and I lend $65 to you based on the value of a house of $100. That's loan to value. What ratio is my loan to the value of the property? In private lending market, you want to make sure that you have a very conservative loan to value ratio. When I say conservative, 65 to 70%. Okay, so my loan of 65% against, or my loan at 65% of the value of that real estate, I feel is very secure. If that borrower stops making payments, I feel that the sale of that property will return my principal loan amount, any outstanding interest and fees and costs and whatnot. So I'm confident at that 65% loan to value. We're not doing loans at 90% of value of property or 95%. Way too risky. We want to stick with 65 to 70% loan to value. I'll talk about that in a minute, but I just wanted to show you what the kind of returns that you can earn in the debt market. And I also wanted to show you that, look, I'm walking the walk. I am invested. This is my REIT. This is what I'm invested in. Okay, this is the TaliMar Income Fund REIT. At the beginning of April, end of March, we had nearly 40 million invested in the marketplace, earning a net 8.87% on that debt. Okay, interest paid out over 281,000 just last month. Total to date is 678,000. So everything I'm telling you today, I am implementing as my own strategy on behalf of my own capital and my investor capital. I'm not interested. You don't need to invest with me per se. I'm just going to give you the strategies, tell you about the opportunity, and give you the strategies I use to lend and take advantage of this opportunity. All right. So we talked about being a lender. You are lending money to real estate investors who are going to pay you monthly for that money. Your loan is secured on a real estate asset. So how do you do it? What are the documents you use? Well, one of the most important is going to be the promissory note. Okay, that promissory note is the document that details the terms of the loan. How much is the loan amount for? What is the term of the loan? Is it 12 months? The interest rate that that borrower is going to pay and the payment amount. So is it 10%? Is it 11%? And then how much they're going to pay you. And then when they're going to pay you. So my suggestion is they pay you the first of every month. Okay. So at the first of every month, you are going to collect a check from that borrower. You're going to add the location of the payment. You're going to tell them where to send the payment. My suggestion is that you work with a third-party servicing company. Servicing company is simply a company that collects the payments on your behalf for a very nominal fee. So they'll act as the kind of the intermediary between you and the borrower. They're going to send the borrower the statement. The borrower is going to pay that servicing company. That servicing company will process your payment for you and then send it to you. One of the biggest advantages of working with a loan servicing company is that, number one, they know the rules for the state. So wherever you're going to be lending or implementing the strategy, you need to follow the rules. In California, there's some very strict rules on collecting payments from borrowers. That's why we have outsourced the servicing of our portfolio. They collect the payments. And I'd be more than happy to provide you names of servicing companies. But they collect those payments and then they process the payment for a very nominal fee. They then drop those payments into our account. So we got the promissory note. Promissory note is, again, what that borrower is going to sign and is stating the terms of the loan that you're going to give them. Okay. But remember, you need to secure your loan against the property that the borrower will use as collateral. All right. And we do that with, in California, a deed of trust. In other states, it's a mortgage. You're going to want to find a title or somebody within an attorney within your state to just understand if it's a trust deed or mortgage state, or work with a mortgage broker, and I'll explain that later, to find out if it's a deed of trust or mortgage state. So that is the security instrument that is recorded against the property for your loan. So if that borrower decides to go sell that property, you have a recorded lien on the property that lien has to be paid off at some point. Typically at the sale of that property, that's going to trigger the payoff of your loan, or if it's a refinance. But no matter, you want to make sure that if the borrower disappears on you or something happens, it doesn't matter, in the sense that your loan is still recorded on the property that he's using as collateral. That's called the deed of trust. Okay. You've got property insurance. This is really important. Okay. You're using for example, a house as collateral for your loan. Well, you want to make sure that the house is insured should there be any damage to the property. Here in San Diego, you have risk of fire. Okay, maybe in Florida, you have risk of hurricanes. Texas or Midwest states, you might have tornado risk. So you want to make sure that you have the insurance on the property such that if there's any damage, that you are covered. So if you have a catastrophic damage, house is completely torn up, destroyed, that insurance will go to pay down your loan. So I'm going to go ahead and jump. Looks like 2 questions came in. It says, number one, nationally, single-family homes are falling in many markets. Are prices in San Diego an exception? There's no guarantee that a rolling correction wouldn't hit San Diego. Do you think there could be a correction in San Diego market? If so, what are the risks of loss? So I can't predict what's going to happen in the next 6 months or 12 months to the housing market in San Diego. I can tell you this, though. We had a significant increase in values in real estate at the beginning of and this is San Diego, okay, beginning of 2022. Most markets had that. In San Diego, we had values increase by over 30%. Right about that May, June timeframe, when the Fed started raising rates, and what you saw in the mortgage industry where interest rates started to go up, you saw an immediate slowdown in transaction volume. Values on the transactions that did occur dropped significantly. And you almost had a balancing. So whatever the market was in January, kind of values dropped about to that range. That all changed right in the December, January timeframe. And again, specific to San Diego, where values started to jump back up again. And that's where we are right now. Values in San Diego are strong. Now, one of the qualities of investing and lending in San Diego is that we have a supply-demand imbalance. We do not have enough housing currently, or even close to being built, to meet the demand that we have. So San Diego is very insulated from, I would say, national economic volatility. Okay, because you have this supply-demand imbalance, and that's what you're seeing right now. That's why you're seeing values of real estate going up. Now, I think there's a lot of media noise out there saying, well, transaction volume is down. Transaction volume is literally 1/3 of what it was a year ago. We have real estate agents, not, dying here because they just can't sell enough real estate. There's not enough real estate. In fact, we just looked last week at the number of listings in San Diego. We're at 1,500. That's serving a population of over 2 million people. Okay, so yes, we have a supply-demand issue, and that is my bet. That is what I run my thesis on, in which I feel confident in the markets that I lend in, being here in San Diego, and I feel confident in LA, using the same thought process. So is the value in loan to value the after repair value or original price? Good question there. So when I underwrite fix and flip loans, I typically underwrite to future value. What the question is, when you land on a property where the borrower intends to renovate the property, okay, those renovations are going to add value to the real estate. In fact, the properties that they're buying are typically uninhabitable. I mean, you're not going to have an end buyer buying these properties because either there's significant, roofing issues, foundation issues, window issues, things that a typical buyer probably is not going to buy that house. So they're going to add value. As a result, I'll go ahead and credit them for that future value. A lot of have a fall to a lot of 65% LTV to still not protect the holder. Yes, I think the not the question, but the comment here is, look, if you're at 65% loan to value, if you're lending at 65% loan to value, the equity of that, or the value of that property, really has to drop significantly before you start to see the value of the real estate drop below the balance of your loan. And for anybody that's invested in trust deeds or investing in what we're doing, the worst thing that can happen is the value of the real estate drops below the value of your property. Okay, something happened, something bad happened. Okay, so that's why you want to keep a very conservative 65 to 70% loan to value. Great questions. Keep bringing them in. Give me just a sec. Okay, property insurance. We talked about that. You want to make sure the coverage, the property that you're securing your loan against, is covered against damage. Let's talk lender and title policy. This is another one that's kind of, in the industry, nobody really understands. When you lend money, you want to make sure that when you record your deed of trust, we talked about this, a deed of trust or mortgage, that it's insured, okay? That the recorded document is in fact legal, that the borrower in fact owns the property such that they can actually allow you to secure your deed of trust on that property, and that there isn't other issues on title. We call this a cloud on title, that there isn't an issue on title of the property that might put your loan or your trust deed at jeopardize its either position or its security. So when I use the term position, I'm flying through a lot of these terms, but when I lend, I use first position loans. That means that if that property was paid off or sold, first position loans get paid off first. Your first position, first money out, and then any subsequent liens, second, third, fourth, get paid out. Okay, so you always want to be in first position, especially if you're new into this industry. You want to be if there's a foreclosure or a sale of the property, you want to get your money out first. That's what it means to be in first position as a lender. If you're in second position, you have to wait for your money to get returned to you until that first position is completely satisfied, completely paid off. So stick with first position loans. So it really reduces your risk. All right, so another question I always get is, Brock, look, your average loan sizes are pretty big. I mean, my average loan size is around 800,000. I don't have $800,000 to lend or invest, and that's fine. That's fine. There's plenty of opportunity around the country to invest in trustees, even if you don't have $800,000. Here's an example of a loan of 300,000. Okay, so a lot of investors may not even have 300,000 to invest. You can fractionalize your investment. Okay, so you can group your investment together with 2 or 3, 4 or 5 other people. Here in the state of California, you have a max of 10 people you can do this with. Other states, I don't know if there's a max, but I know in California, there's a max of 10 people. Okay, so you and 2 other buddies can put $100,000 together and you lend that money out for a loan amount of totaling of 300,000, and you earn the interest on your interest in that loan. So let's say this loan is paying 300,000 and earns 10%. You can earn 10% on your 100,000. And now there's some rules and risks in doing this. You really should be using a very experienced trustee or mortgage broker that specializes in structuring these kinds of loans. You can find them easily. Just Google search it. If you're in San Diego, there's plenty of people that show up in San Diego or wherever, whatever state or city you're in, you'll find somebody. But make sure they're experienced. Okay, find out what their background is, what their success is. But you can fractionalize, you can put your loans together. So if you're in the Midwest, average loan size is 150,000. It's much smaller. So there's plenty of opportunity elsewhere that you don't need to have 100,000. You don't need to have 50,000. You can have a smaller amount to invest this way. Okay, we've got some more questions. Let's take a look. Do you implement any type of construction monitoring or fund control to help eliminate risk of mechanics liens or project completion? Okay, so we're getting kind of in the nitty gritty. I don't do construction loans. I do what we call fix and flip loans. And most of this type of stuff, there really isn't heavy mechanical construction work, physical construction work, other than, maybe they're removing a wall between a kitchen and a bathroom, or a kitchen in a living room. But a lot of it's carpet, paint. You might have some foundation issues and roof issues. So in terms of construction monitoring, we do have what's called a construction holdback funds. Okay, and we disperse those funds to the borrower over the course of the project. So if we have, let's say, 50,000 set aside for a borrower to clean up a property, the borrower is going to finish work. We're going to make sure the work is completed, and then we'll go ahead and provide payment or funds to that borrower to reimburse them to go to the next step. So that's somewhat of the how far we go with construction monitoring and fund control. And then mechanics liens, if you get a real complicated project, when you start getting into ground up construction or maybe bigger additions, yeah, you can start to monitor mechanics liens through title companies and whatnot. But again, the level of work that's being done, you're probably is going to be overkill for the types of loans we're funding. But if you're second, you can very likely settle the first and take over. Okay, so the question comes, well, you may have investors that are okay being in second position and try to settle with the first and take it over. Well, yes, if you are in a position, let's say you've got a $500,000 loan in front of you and you lend in second position on a $100,000 loan, you need to be in a position to continue to make those payments current. Because if you don't, that borrower or that first trustee lien holder could put that loan into a default, implement a default rate, and they may not want to have a conversation with you. They just want to earn their default rate. And so you're stuck keeping the first current, making sure you're paying it on behalf of the borrower to keep it current until such time as you initiate a foreclosure. Now, let's say in case that a borrower decides, well, I think this whole thing is unfair. They start to sue everybody involved. And now you're involved in a lawsuit that could take over a year. And during that period of time, you're still trying to keep the first current. So for people that don't have a ton of liquidity to keep a first current, or may not have experience in renegotiating a first or trying to negotiate with a first trustee lien holder, my recommendation is always stick with firsts. If you experienced and you understand seconds, you can get pretty good returns on it. But I always tell my investors, if you're going to do second trust deeds, make sure that you have enough liquidity set aside in an account that you can draw from to ensure that your second stays strong, stays in a good position. And you got to consider, if I'm going to put money aside to hold that, well, that reduces the overall return I'm going to earn, because that money isn't doing anything, it's just sitting in an account. So stick with first, just stick with first unless you know what you're doing, and still stick with first, because I stick with first. Answer live. Another question, is there an issue with the first? You get the opportunity to get a good deal by likely a smaller amount lent. Yeah, I mean, if you, again, this kind of goes on to the same question, you might be able to renegotiate the principal balance of a first down. I don't think in today's market, you're going to have a huge amount of success trying to negotiate with Wells Fargo to say, hey, why don't you take a reduced payoff? Maybe you can. But a lot of these, larger banks, they just don't have the time to negotiate on a one-off loan. They're just going to go and wipe out anybody behind them through a foreclosure action. Okay. So let's continue. So we talked about fractionalized loans. Let's talk about why we see a huge increase in the number of people using their retirement funds to get into the private lending space. Number one, this idea of a self-directed IRA has become mainstream. It's super mainstream. When I first started, it was kind of a gray industry, but now people are taking retirement funds from a traditional IRA. When I say traditional, just called generic IRA. It could be a traditional IRA, Roth IRA, rollover IRA, whatever you call it, are taking money from their IRA and out of conventional brokerages like your TD Ameritrade, your it's not E-Trade anymore, but Ameritrade and some of the other bigger brokerages, and transferring those to what we call self-directed IRAs. And what that does is allows you, the investor, to get out of being restricted of the investments that only, let's say, TD Ameritrade offers, right? Stocks, bonds, those traditional, maybe fixed income investments, to allow you to invest in a huge other opportunities outside of what's on their platform. So a lot of self-directed IRA investors have taken the money and moved it to a self-directed IRA and bought real estate with it directly. Okay, they've invested in the private debt market. They've invested in a huge amount of opportunity. We've recently heard some of the very wealthy billionaires invest in companies using their self-directed IRA. Peter Thiel, I think, had over $2 or $3 billion in his IRA. I don't know how you can get that much money into your IRA when you're restricted to under $10,000 in deposit, or what are we at, 12 or 13,000 every year you can deposit into it. But you can take advantage of the loopholes that are open to these billionaires of utilizing the funds in your IRA to invest in things other than what a typical brokerage would allow you. So you find a custodian. I'd be more than happy to introduce you to a couple, and you can take those funds and invest it in the private debt market. And about 20% of the investors that I work with are people that use a self-directed IRA. These are people that are looking for a alternative fixed income asset. Okay, they are not happy with the opportunities, the options that are offered to them in a traditional brokerage, so they're pulling it out and investing in what they see and what I feel is a better alternative fixed investment. And best of all, you can still retain the tax advantages of investing through an IRA, right? You can get the tax deferral or not be charged any tax on the income that you receive. You get to retain those same benefits that you have in your traditional Roth rollover IRA in the self-directed IRA. Again, if you're interested in learning more about this, I actually have a great podcast, or actually webinar, posted with Brian Davis of AccuPlan Benefit Services on my YouTube website. So go there, take a look at it. He does a great job of explaining what a self-directed IRA is. All right, so let's talk about the guidelines that I use. So how do I approach lending in today's market? Just double check here. So another question came in here. I know you're not a tax advisor, but if I invested self-directed funds into your mortgage fund, okay, this is the fund that I manage, Do you know if it would prohibit me from accessing the same funds on the other end? Yes. So this is one of the hurdles that we have as a mortgage fund, that when we manage investor funds that come into our investment, we got to be super careful that we're not pushing that money back out to investors or to borrowers that have invested in our fund. It's called self-dealing. There are ways around it, and I can talk to you specifically about ways that you can get around that loophole, but generally it is frowned upon if you invest in my mortgage fund and then I lend that money right back out to you. All right, so here are my guidelines on how I lend my money. Okay, so again, as you probably could tell, I like first trustees. I think that for me, it's a safe, secure investment. I'm not interested in taking the time to manage a first if it goes into default or deal in second position and take that risk. Honestly, I like to sleep good at night. I just want to put my head down and just know that I have my consistent monthly cash flow. My payment every single month is going to be in my bank account. I've done seconds. I've made some pretty good money doing it, but it is stressful and I don't need to be losing any more hair. So stick with first. Loan to value, 65% or below. I like to be at 65%, especially here in the markets that I lend in. If you are in more volatile markets, and I'm not going to say Las Vegas or Phoenix or those markets are more volatile, but they are, okay? You may even want to even reduce what your loan to value ratio is. But markets that have a big investor presence in it, where the values of real estate are really predicated on the investor community, you want to be much more risk averse in those types of markets. Here in San Diego, you have a lot of owner occupancy demand. You have a lot of out-of-state second home demand, and you have a lot of investor demand. So if one of those demands or sources of demand dries up, you always have these other two sources of demand that's there to kind of keep buffer the marketplace. Property types. If you're first time doing this, stick with first single family and small multifamily. Why? They're the most transacted type of real estate. Okay. The best thing about a single family house, and you have to take it over, you can always rent it out. There's always going to be a use for that property. Heck, you could move into it if you wanted to, but there's always going to be a use for it. Okay. That is on the opposite spectrum of land. I don't lend on land. I hate lending on land. Okay, because the only value to land is what the future value is. And if there's no future value, you have no value on that piece of land. I'll tell you, back in 2008, not that I was involved with them, but I did see several large mortgage funds go bankrupt because they were heavily invested in land development projects. If you're here in California, you'll know what I mean, but like in the desert, Palm Desert around there, a lot of Central California, a lot in Arizona and Nevada. And when the market turned on them, nobody was buying homes. Well, nobody was building homes. And when nobody's building homes, they're not buying the land to build those houses. So there's no market. Okay. There's plenty of opportunity to lend elsewhere. I get it. Look, there's great returns that you can earn on investing in land. And it gets very tempting. I mean, there's some really interesting deals that come across my desk. But then I look at all the other opportunities that are out there and I say, you know what? I don't need to take that risk. I've got all these other great opportunities that let me sleep well at night. So I'm going to just stick with my single family, multifamily, and in another product type though, if you're invested in, for the first time, you don't have a lot of experience, warehouse, industrial, huge demand here in San Diego, huge. And they're going to pay big money for your capital, right? But if you don't know how to manage that type of real estate, just stay away from it. Go with single family, multifamily. Loan terms. I always tell people stick with 24 months or shorter. Why? Well, if you had lent a loan, let's just say a year ago for a 3-year term at rates a year ago, you're under market. Okay, you probably were lending in the 8, maybe 9% range for that money. Well, you're waiting another 2 years to get your money out of that loan to earn what is in today's market yield or rate, what you should have lent at. That's why I like to stick with short-term loans. Also, you're not taking market risk. So I don't know what's going to happen with real estate 12 months from now or 24 months from now. There can be a complete collapse of real estate, but I want to be liquid enough, or I want my loan liquid enough that I can get out if I need to be. And if I'm stuck in a 36-month loan, I can't get the money out of that loan. So I like to go shorter term. Now, what I do in some cases, and this is a really cool idea, is that you can do a 36-month loan. And if you're worried about where rates are going, you can do, keep it fixed for 12 months and then make it adjustable. All right. So maybe every 12 months, that loan adjusts to what the market value is. Now you're taking the risk of values, if rates go down, that the return you're going to go down, but I just don't see rates going down in the near term right now. So we've underwritten a couple of short-term or adjustable rate loans that adjust every 12 months. Invest locally. Okay, I say this with everything. If you're going to buy investment properties, I tell people invest locally. There's plenty of opportunity in the local market. It's really tough unless you have got really good boots on the ground. You trust who your advisors are in a different market. It's really hard to invest successfully over the long term out of your general market. That's why we lend specifically here in San Diego. I know it. I can see the real estate, and I can meet the borrower. So I feel confident in the San Diego market. So invest locally. I know we're kind of cut on time. We may go a little over. It's just too much fun talking about this kind of stuff. So credit score 675 or higher, very important. We don't lend to bad credit borrowers. I know there's other people out there that will, but I don't care the story. Their credit isn't going to get better. It's going to stay the same. Okay. I don't want to be chasing payments down. I don't want to be on the phone with somebody explaining to me why they can't make the payment this month. It takes my time. My time is valuable. Look, if I was retired, I want to be out on the beach enjoying my margarita. I don't want to be on the phone with somebody explaining to me why they can't make the payment. 675 or greater. Why do I say 675? I don't know. I've been doing this for 15 years, and I just find like that 675 number, anything below it, they just have a history of late payments. They have a history of defaults. Anything above 675, and they may have 1 or 2 late payments, seems okay to me. So I just like 675. That's what I tell everybody. Ownership type, non-owner occupied real estate. State of California here, it's made it virtually impossible to lend on owner occupied properties. Okay, you got to have different license, not that you have different licensing, but there's different reporting that you have to do owner occupancy. And it's smart. After 2008, the federal government said, hey, banks were taking advantage of homeowners. And so we're going to make it much more strict on to lend to owner occupied borrowers. Plus, we're going to give them more rights. So if they don't make a payment, they can decide, hey, you shouldn't have lent me the money. Therefore, you're at fault, lender, not me. And I just don't want to deal with that. I also find that people that owner occupants have an emotional attachment to the real estate. Okay. They don't want to lose the real estate. Okay. Even though they know the best option is to sell it and pay back the loan, they have this attachment to real estate. I just don't want to try to break that attachment. If you work with an investor, most cases they understand they have to sell the real estate if they can't make the payment and get me my money back. So that's why I do non-owner occupied. And even if it's a little gray or fuzzy, don't take the chance that that borrower is going to live in the property. Okay. I focus on fix and flip loans and bridge loans. What does that mean? We talked about it. Borrower intends fix and flip. They intend to add value. I typically hold back funds to lend to that investor to improve the property. That's a fix and flip loan. Bridge loans, based upon current value, set period of time, 12 to 24 months. And the borrower just needs it to either close on the property, maybe refinance an existing loan, but they just need it for a temporary time. Looks like we got some more questions coming in. Let's go ahead and take a look at it. Oh, I appreciate the compliment. Thank you very much. Someone likes what I'm talking about. Great. I got another one. Thank you for the content. I appreciate it, guys. Brock, talking about credit score. The credit score is an LLC credit score or personal credit score? Good question. So personal credit score. So I always do personal credit scores. And a lot of the pushback I get from borrowers is, hey, I don't want you to check my credit. Okay. It's going to ding my credit. It's not going to ding your credit. Okay. Maybe 5 points. That's about it. But I want to check your credit. And again, it's one of the biggest predictors on the success of a loan is the borrower's credit. So even if you're at 25% loan to value and the borrower has a 500 credit score, it's an immediate no. Just an immediate no. I don't care if it's the Taj Mahal landed right inside downtown San Diego. It's just that I don't want to deal with bad loans. It takes so much time and resources to deal with a borrower that isn't making payments. And you run the risk of that borrower getting in some type of litigation or something that I just don't want to. I've been there, I've done it, and it's just not worth my time. If you want to take advantage of it, you can get better returns, but you're getting paid to take that risk. And I just not again, I look at this as, can I sleep at night with my loan portfolio? Right now, I can. That's how I look at it. Good question, though. Keep them coming. I like these questions. And again, there's no one way to do this. I mean, as you can tell, some of these questions, people like second trust deed liens. I get it. I see it. Some people like to invest out of state. I understand. You can get better returns, lending in Nebraska than you're going to get lending in Southern California. So there's different ways of looking at this industry. If an LLC, do you get a personal guarantee? Okay, so yes, I always get personal guarantees on 99.9% of the loan, but we're probably going to be funding one of those loans, I don't know, sometime future I don't get a personal guarantee. But yes, so personal guarantees, what that means is I like to lend to LLCs. It further demonstrates that it's a non-owner occupied property, that's business purpose, it's an LLC. I'm not saying that defines owner occ versus non-owner occ, but it just kind of goes to further get me comfortable with the story. But if the company is the borrower, there will always be an individual involved, and they will guarantee that loan on behalf of the LLC that is the owner of that property. So yes. Now, the couple of times I've not done the personal guarantee is that the borrower was a self-directed IRA. And if the borrower that owns the property is a self-directed IRA, they cannot personally guarantee the loan on behalf of their IRA. That would be self-dealing. And I've done a couple of those, low loan to value. I knew the borrower. I felt comfortable with the scenario. So I did it didn't create a personal guarantee. But in most cases, nobody should really care about if they're signing on a personal guarantee. And that's one of those things that if somebody says, hey, I don't want to do a personal guarantee, it's a red flag right there. Like, why? And do you are you intending to default on your loan? Is that the problem? So it's a red flag to me, and I typically will get, most cases, 99.9% will get a personal guarantee. I'm just reading through the question here. Are the returns mentioned inclusive of fees, or are you, TaliMar, collecting and keeping fees, passing along the full interest expense to investors? Okay, so let me go into that question. That's a good question about if you're investing with me. That's not really the purpose of really what I want to get at today, but I'll kind of mention that at the end. Answer live. Really, I would just want to educate individuals so that they don't, first of all, to identify the opportunity in the marketplace right now, this huge opportunity. And then if they do want to get in, how to get started. Okay, so when you're doing your due diligence, so you're interested, so let's establish this. You're interested, you see the opportunity, you want to get started, okay? So you want to get started lending, okay? You've been given the parameters of what you're willing to invest in. 65% loan to value. You want to be in, if let's say you're in Boca Raton, Florida, you're going to be lending in Boca Raton, Florida. Okay. You want to stick with single family houses, all doable in Boca Raton, Florida. I promise you, and you're going to get pretty good returns. So you've demonstrated that. Now I've been presented an opportunity. What should I do with the opportunity? How do I know it's a good deal for me? Okay. First thing is you want to understand what is the property value. Okay, remember we want to stick at 65% loan to value on the property. So if you're new to it, get an appraisal. Get a third-party appraiser to value the property. You can also get what's called a broker price opinion, also known as a BPO. That BPO is kind of a what we call not as doesn't have as much information as an appraiser. BPO they may not go into the property, but it's not going to offer as much information about the property. But either way, both those documents are going to provide you a value. And I typically like to see them done in the last 3 months. If it's the market today, I may be in the last 30 days just because there's some volatility in the market, but that's going to establish value. Okay, but read through the appraisal. Okay. do just a little due diligence. Just look through there, look at what, the appraiser has, the appraisal have some comparable sales. It's going to take sales from the area and say, okay, does this make sense that the value that the appraiser came to, because there's a lot of appraisals out there that are just, they're not worth the paper they're printed on. Okay, well, we don't print appraisals anymore, but that you see on a PDF. Okay, so number one, establish value. Okay, is your loan amount at least 65% or below what the appraised third-party valuation is? Okay. Second, credit report. Get that credit report. Don't let the borrower give you the credit report. You're going to get it. All right. Now, most of you are going to be working with a mortgage broker who's going to present this deal to you. They should be getting the credit report for you. If you're interested, I can go ahead and show you a couple services. I'll email me at the end of this and I'll send you a couple services that you can use to get a credit report, but get it within the last 30 days. Okay. Also, do a Google search on the person. Okay. I had a loan presented to me, perfect credit, everything is good. And I just did a quick Google search on the guy and I found that he was indicted down in Mexico in some drug conspiracy. Okay. I would have never seen that on a credit report. Okay. But I just Google searched the person. I found it and I said no, simply because you don't want to be involved with people that have ancillary issues like that, especially that one. But I mean, there's going to be other ancillary issues. So Google search the person. You're going to find a lot about the person. You can Google search their name. You can Google search their address, their phone number, anything, something will pop up. Even look at their social media. Cash flow statement. I want to demonstrate that they can make the monthly payments. Show me something. Okay. I'm not going to do some calculation of their ratio, their income ratio and all that, but I want to say, hey, give me your tax returns. Give me a W-2 statement. Give me a cash flow statement for your business. Something that's going to say, hey, you can make those payments on your loan. Okay. Property condition report. Okay. I want to see what the condition of the property is. If you're out of, this is why it's hard to invest out of state. It's hard to determine what the value of the actual real estate is. Me personally, I'm local. I can go see the property. So I can just see it right there, but I want to get a property condition report of some type. That can also occur with with an appraisal or a BPO. BPO may go into like, hey, property's in good condition, poor condition, and you can see it from the photos. Site visit. Highly recommend it. If you're in local, that's why it's important to invest locally. You can go drive by the property. Do you feel comfortable with the asset? Do you feel comfortable with the neighborhood? Okay. Do you see yourself owning that real estate and managing it if necessary? And then project budget. If you're going to do fix and flip loans, okay, or understand who holds those funds over the course of the project. Look, I'm not going to fund a loan of which the borrower is supposed to do a set amount of renovations, and I'm just going to give him the money to do it, right? It's like giving a contractor to do the work on your house. Well, where's he going to go? He's going to take the money and he's going to go down to the bar with it, okay? Borrowers will do the same thing on you, trust me, okay? When the work is done, I'm going to give you money. When that work is done, I'll give you more money, okay? But not until the work is done, okay? I know borrowers are going to come back and they're going to fight you on, hey, well, I need money today. Well, we agreed on that you were going to finish the cabinets, okay? And then I was going to give you $5,000. Finish the cabinets, and I'm going to give you the $5,000, okay? So you hold the money until the work is done. Okay, so we talked about, again, how I look at investing in trustees. We talked about kind of my requirements, my credit box, what are the documents that I need for a loan. Now the question becomes, where do I find deals, Brock? Like, I'm excited. I can get good return on my money. I can, I can invest locally. I can get that consistent monthly cash flow. I don't have to deal with the stock market going up and down. Where do I find these deals? Well, number one, the best source is going to be trust deed and mortgage brokers. Okay, Google search trust deed mortgage brokers in Boca Raton, Florida, or Austin, Texas, or Seattle, Washington, wherever you are. Go ahead and Google search. You're going to have a huge list of potential trust deed brokers. Okay, contact every one of them. At least contact 5. Okay, and I want you to ask the following questions. Number one, how long have you been doing this? Number two, how many loans have you funded? Of those loans, how successful were they? Okay, so were they funded correctly, and did the borrower pay off? Okay, talk to some of the other investors, okay, that use that broker. What's their experience? And you're not trying to find necessarily if things went bad per se. What you're trying to find is, does that broker provide trust deeds that meet your credit box? Okay. So if that broker just does second trust deeds and you only want to invest in first, you don't want to waste your time, nor do you want to waste that broker's time. Okay. So ask those kinds of questions. All right. So contact the trust deed brokers, let them know who you are, let them know how much you have to invest, let them know how quickly you can invest. You have to be upfront about your credit box, though. You have to say, look, this is what I'm looking for. Number one, can you provide that? And number two, I will fund your request if it comes to me using my credit box. Okay. So you got to be willing, if the broker's going to do the work for you to find that opportunity that you're looking to invest in, to do the deal. Okay. Real estate networks. This is how I find majority of the trustee. Well, now I got a sales team that does it for me. But when I first started, I would go down to local real estate networking events and just hand out my card. Say, I'm a private lender. I'm looking to lend money to real estate investors. Here's my credit box. If you have anything that you need to borrow, let me know. And I would get loans that way. Real estate agents, another great source. Agents are agents are hungry. They want to get their sales closed. So if a conventional lender isn't going to work, they want to be able to contact you as a private lender to fund the loan that they're trying to close, because they don't get paid until that transaction closes. And don't expect you'll ever get them back on the phone after the loan closes, but they want to get their loan closed. So go ahead and network with real estate agents. Other professionals in the industry, contractors, title escrow agents, appraisers, another great source. So appraisers are always out there. They can always give your information out. So network with other professionals, and then use social media. Something I do a lot of, and it gets my name and my brand out there. But if you've got money to invest in trust deeds, write that out on Facebook, on LinkedIn. You're going to get a ton of requests. Say, hey, I'm looking for XYZ trust deeds. Would you please contact me? You'll get a ton of brokers contacting you. Just be careful, okay? Because there's a lot of scams out there. Make sure you know who you're working with. We're still running over time, but we're having too much fun right now. Okay, more questions. All right, they're coming in. You mentioned a broker bringing you the deal. How do you find the broker? So that's what I meant. So yeah, use social media to get your name out there. Do a Google search for trust deed broker. That's probably the best one you can do. Trust deed broker, TRUST space DEED, trust deed broker. Best way to get those leads. Do you have broker's license when you are direct soliciting to people? Yes, I have my California mortgage license. Now, I technically don't even need my California mortgage because we're licensed, because we are a mortgage fund now, and we lend under what's called a California finance license, CFL license. So that's the license that kind of encompasses all of my salespeople in my group. As I understand it, not anyone can do it. However, the limits the rates on usury laws. This is a great point. Thank you for bringing this up. I kind of didn't mention this. So you got to be careful. In some states, they have what's called usury laws. Usury laws are to protect borrowers from payday loans, from loans that have super high interest rates. Okay, that's not what our industry is. We're just providing an alternative financing option to investors who can't go to conventional lenders. We're not there to charge them 30% on their loan. Okay, but in the state of California, if you charge over a certain percentage, you have to have a license to do that, or go through a licensed broker to do it. Okay, I don't know about other states, okay, but in California, you need to go through a licensed broker. Go through a trustee broker to do a loan. In fact, I would recommend, if you're doing it for the first time, reach out to a trustee broker to just walk you through the process, okay? Pay them a little for their knowledge, okay? So you can see the process, and then you'll be protected under their license. So good question. Thanks for bringing that up. All right, so let's go ahead and things that you can do to mitigate your risk. And I really covered a lot of this stuff. Stick with your underwriting guidelines. I know there's going to be a deal in front of you that's paying higher than what you're used to on a return. It looks great, but there's a reason why they're charging you a higher rate, and you want to stick away from that. Stick with your gut. I kind of just bounce back down to the bottom bullet point, but stick with your underwriting guidelines. focus on core assets in urban markets. I don't want you lending in the middle of the desert where there's no other real estate and there's no other transaction volumes. Again, the rate might be great, but if you end up owning that property, you're going to be owning a property in the middle of the desert that you can never sell. Stick in urban markets, okay? Core assets, single family, multifamily. Don't go and get that mixed use asset that works as a marijuana dispensary, okay? I'm not saying those are bad investments. I just don't understand them. I don't know what to do with a marijuana dispensary if I were to have to take it over, nor do I want to try to learn about it. So I just don't lend on that, okay? So stick with core assets, single family, multifamily, or other assets that you're comfortable with, just no land, okay? Use third-party vendors, okay? Loan documents, really critical today, okay? If you get a loan that goes bad, and that borrower sues you, the first thing the attorney is going to look at are those loan documents. Are they legitimate? Okay. You can't just rip them off Google. Okay. These days you can't do that. I know there's loan docs through like Loan Depot, or I'm sorry, there's some other doc depot or something. You need to use attorney drafted loan documents. There's a couple services out there. We use Gerasi Law Firm. They've got a great service. It's called Lightning Docs. Write this down, Lightning Docs. It's a lifesaver, okay? And I'll be more happy to introduce you to them. But if you do contact them, let them know that I sent you that way, okay? They sometimes give me a dinner if I send somebody over. So Lightning Docs. DOS Law is another one. We haven't used DOS Law, but I've heard it's a great service as well. Same idea, that you log on to their website, Lightning Docs or DOS documents, and input all the loan information. It checks the loan to make sure that it's legitimate. Okay, inputs all that information into the documents, provides it to you, and now you've got a attorney drafted set of loan documents within minutes. Lifesaver. Okay, so Gerasi Law recommend, DOS Law is the other one. Loan servicing. Do not try to collect your own payments, especially if you're the first timer. Okay. Use a company. We use FCI Lender Services. I'll say it again. What was it? Frank Charlie Industry, FCI Lender Services, to collect the payments on our behalf. There's other servicing companies out there that you can use that are just as good. FCI is just one of the largest that are out there. Okay, they're going to follow the rules in your state to collect payments. They're going to be able to provide the borrower monthly statements, and God forbid the loan goes bad, they can help with the foreclosure process. I think the cost is $15 per month. And if you're telling me that it's more worth your time to go for $15 to go collect payments from the borrower, deal with all that stuff, I'd say you're lying. Okay, I'm serious. Don't do your own servicing. Aggressive collection of payments. You need to be aggressive, okay? We're all trying to be nice guys. I know you're lending money to an investor. You want their repeat business, but if they don't make that payment by the payment date, you're on the phone with them, okay? Why is the payment not made? You're sending a letter, okay? Why is the payment not made? Okay, and then you immediately, per the rules of your state and by the guidelines of your servicer, start a foreclosure action. You can always pull and stop a foreclosure action when that payment is due. What you can never get back, though, is if the borrower says, I'll pay it, and you're just sitting there not starting the foreclosure action, you find yourself 3 months into a non-payment loan, and then you start the foreclosure action, okay? Markets could have changed. The property condition could have changed. Something could have changed in that 3 months. You need to start the foreclosure action immediately. Be aggressive on the collection of payments. That's the number one biggest mistake I see from private lenders after a loan is funded. Okay, funding a loan, approving it, doing it is only 50% of the battle. The other 50% is getting the payments and making sure it's a successful loan. Listen to your gut. Important. At the end of the day, something doesn't sound right. Borrower's not answering the questions you want, like in the way that you want, or the property or something wrong. Your gut is telling you, and they're always right. I can't tell you how many times I've gone back and looked at the loan that may have not performed like I wanted it to, and I go, you know what? Those were the signs. I saw it, I knew it, and I was blinded myself to it. So listen to your gut. Okay, so real quick, what is it that I do? I do exactly what I just told you. Okay, at the end of the day, I do that with my money. Every single day I get up and I look at loans. We look at probably 10 loans a day. All right. We specialize. I have a whole team dedicated to finding me loans, servicing my loans, doing everything and doing investor relations. So I invest on behalf of high net worth investors who want to get into this investment, but may not want to do it themselves. They don't want to go out and try to make relationships with mortgage brokers and whatnot and deal with this stuff. So they invest in what is called my mortgage fund, right? So they pool their money and they invest in a diversified portfolio of loans. We've got, I think, 57 loans in my portfolio. So the nice thing about that is it's a diversified approach to investing in exactly what I just talked about. So if any one loan goes bad, you know what? You've got, in case, 54 other loans that are still performing. I'm still earning that consistent monthly cash flow. So that's what me and my company do. I identify new lending opportunities for them. So, instead of them, again, going for mortgage brokers and trying to create those relationships, I'm there doing it for them. And I'm not saying I'm better at it than they would be. It's just that I have an entire team dedicated out there to talking to every borrower, every broker, everybody out there that needs money. My sales team is going to go out there and find that opportunity. So that's what we specialize in doing. We talked about the diversified capital over a pool of mortgages. Look, when you invest in trust deeds, one of the biggest risks that you have to your consistent monthly cash flow is that borrower stops making payments, right? Your cash flow stops, right? It's no fun. If you invested in trust deeds and that money stops, it's not fun to try to get your money back. So we act as that platform. Okay, they invest in the platform, our mortgage fund. It's our responsibility to go through that process of getting that payment from that borrower and getting that payoff. Our mortgage fund, we have a little over 43 million in our mortgage fund currently. People say, well, Brock, I thought you had 55 million that you serviced. That is true. The other 12 million, actually it's less than that now, is with individual investors. So we had shifted over from investing on behalf of individual investors to the mortgage fund about about 2 years ago. Ensure investors get monthly distributions. We talked about this. My investors, if you were to tell what is the prototypical investor that invests in the mortgage fund, Brock, that is someone who is nearing retirement or in retirement, probably 50 plus years of age, doesn't want to deal with collecting payments, wants that consistent monthly cash flow, doesn't like volatility, definitely doesn't like surprises. So when I talk about my mortgage fund, it is the most boring investment you're ever going to make, okay? You're just going to collect monthly payments. You're not going to hear about loans blowing up or something happening. It's the most boring investment you ever make. But I'm a fun guy. I try to be, at least. So, and then educate my investor base. So I am always doing these webinars. I post a ton of great content on YouTube, right? So the content on YouTube talks about the private lending industry. I want all of my investors to understand what they're investing in, obviously what the opportunity is, but also understand what the risk is, okay? So always educating stuff on where the trends are. Something new is always happening. So always educating my investors. All right, so real quick, I want to explain what a mortgage fund is. So on the left-hand side here, you have investors. So I have about 150 investors that invest in my mortgage fund. So all of those investors whose investments range from $50,000, which is our minimum. I think our largest investor has about $1.8 million in our fund, all invest in the mortgage fund. So they all pool their capital into the mortgage fund. And then as the general operator of that fund, I decide where we're going to allocate funds to our loan portfolio. So I'm the one that makes these decisions using that criteria I talked about, investing in or lending out using real estate as collateral, all in first position loans. So that's it. I technically call myself the bank. Money comes in just like a deposit, and that money goes out on loans. So what are the advantages of a mortgage fund over a trust deed investment? So we've been talking about trust deed investments. They offer great options, great consistent monthly cash flow, plenty of opportunity out there, the security of real estate. But there's also a different strategy you can use that is a little more passive in your investments. So if you're not interested in going out and finding and dealing with all trust deeds, you can invest in the mortgage fund. Number one, you've reduced liability. So, if a loan goes bad, it isn't you getting sued, it is the fund that would get sued. So a lot of people want to take that reduced liability. Number two, it's diversified. Okay. So my job is to ensure that you're getting your monthly check every month. You're not interested in one or two loans going bad. You're interested, Brock, I want my check on the 15th of every month deposited into my account or reinvested into my account. That is my responsibility to my investors, is that they get that payment. Number three, consistent investment platform. If you invest in trust deeds, you're probably familiar with the fact that you have a payoff, then you got to get that money back out. The problem is, between the time you get your payoff, by the time you get the money back out, you're not earning any income. Okay, it's just dead money sitting in a checking account. So in a mortgage fund, your money is always working for you. No matter if a loan pays off in the fund, you're always getting that consistent income. 20% tax deduction on distributions. This is probably the biggest advantage of a mortgage fund, or our mortgage fund, over trust deed investment. You get a 20% tax deduction, no matter your income, on the distributions that we pay out on our mortgage fund. Okay, you don't get that on trust deeds. It's ordinary income. Okay, you don't have that option. Mortgage fund, as I mentioned, is more passive, right? So you're not having to look for trust deeds. You're just interested in, hey, what's the performance of the fund? We're going to have better access to loans than you will as a trust deed investor. It's just plain and simple. I've got a whole team dedicated to finding loans. And secondarily, I've got a whole team to underwrite those loans quickly and then fund them and manage them. Okay. So we have a whole platform that specializes in doing exactly what I talked about. And typically, we're going to be more flexible option of investing in this segment than individual trust deeds. When you invest in a trust deed, you're only going to get your money out once that loan pays off. All right. But in a mortgage fund, it's a little more liquid. Okay. I have loans paying off all the time. So you may want to invest. Let's say you have $100,000 to invest. You can invest immediately versus a trust deed where you have to wait and find a trust deed that has an allocation of $100,000. And you don't know when that's going to happen. Okay. Now, when it comes time to take your investment out in a trust deed, you have to wait for that trust deed to pay off. That's different than a mortgage fund where you're going to submit a withdrawal and we're going to get you your funds back. So that's the big differences between a mortgage fund and a trust deed investment. The advantage of a trust deed investment, the number one advantage, is you have slightly more control. You get to select what loans you're going to fund. And I have a lot of investors that say, look, Brock, I think you do a great job. You've got great experience, but I just want to select the loans that I'm invested in. God bless you. I mean, it's work, but good for you. So, so real quick, if you're interested in learning more about our mortgage fund, we have the option. You can go onto our website at TaliMarFinancial.com. TaliMarFinancial.com, and go under the investing tab, go to TaliMar Income Fund, the tab, and request the executive summary. We'll provide you all the information on the fund, up to date, the returns that we're returning on the mortgage fund, and kind of our strategies. So feel free, again, go to the website, TaliMarFinancial.com, select TaliMar Income Fund, and download the executive summary. So I want the takeaway for today, okay? We went way over, but again, lots of content to go over. Investing in trust deeds is a huge secret in the industry, and it shouldn't be. It's a great opportunity to earn consistent monthly cash flow using the security of real estate. It's a huge opportunity to earn great returns, so it shouldn't be a secret. Number two, incredible opportunity in the market today. So look, with inflation, with banks pulling back on the lending, there is a huge demand for your capital. You can get paid for it. Number three, consistent monthly cash flow, right? We talk about this. How do you invest in today's market and earn consistent monthly cash flow? This is one of the best options that are out there right now. And the best of it is you can invest in real estate and not actually have to own the real estate. You don't have to deal with tenants, toilets. You don't have to deal with any of that. You can just invest in real estate, use real estate as collateral, have that borrower make payments to you every single month. Much more liquid of an option than owning rental properties. Okay, it's easy to get started. Plenty of opportunities in your home market. Boca Raton, Florida. Go call that trustee broker. Tell them you're ready to get started. Okay, Take advantage of that opportunity. Okay. Maybe you don't want to invest in individual trustees. Maybe you want to invest in our mortgage fund strategy. Always available to talk to you about our mortgage fund. And listen to your gut. I got to list to your gut, but I meant to listen to your gut. Okay. If something doesn't sound right, don't get involved. There's plenty of other opportunities. All right. With that, I'm going to end it. I'm going to say thank you very much for spending your valuable time listening to me. Hopefully, I provided you some good content, some information that you may not have already known. If you're new to the industry and you want just to run some ideas by me, feel free to contact me. I got my contact information here. My phone number is 858-242-4900. Again, 858-242-4900. Or email me at bvandenberg, that's B as in boy, V as in Victor, ANDEN, that's N as in Nancy, B as in boy, ERG. So VandenBerg at TaliMarFinancial.com, TALIMAR Financial. That's T as in Tom, ALIMAR Financial.com. Or go to our website. Easiest way to get a hold of me, TaliMarFinancial.com. Thanks for listening. Look forward to hearing from you.